TOST reported their latest earnings report on Thursday after the market closed. Numbers were pretty good. The market is rewarding the stock. The stock is up 15 to 17%. Now, next week, Block will report their own earnings report. So maybe we might get some indication as to how that industry, the restaurant industry, is doing, because Block itself is also serving that industry, which is why I'll keep on saying I much rather own a company like Block or stock like Block that also serves the restaurant industry, but serves a lot more than that. TOST is focused just on the restaurant industry, which in my opinion makes this just a feature-like company, which I rather avoid. But we'll go over the numbers right now. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not. Would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comments to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first things first here, the big expectation is that they anticipate GAAP operating income profit by first half of 2025, which is in line with what the analysts are expecting. The board of directors also authorized a share repurchase program, and they also announced layoffs. More on that in just a second. Now, I do want to say that this is a growth company. Unlike many other so-called growth companies or pandemic growth companies, this company is still, in my opinion, in the category of growth companies. When you see ARR growing 35% year over year, GPV up 32% year over year. Total locations increased 34% year over year. Revenue that increased 35% year over year. I mean, this does classify this company as a growth company, which means it usually gets a higher premium from the market, which I'm fine with. Then when you look at profitability, well, it's not profitable yet. Net loss was $36 million compared to a net loss of $99 million same quarter last year. Now, net cash provided by operating activities was $92 million and free cash flow was $81 million. Large part of it comes from SBC expenses. Now, as for the full year 2023, again, this reaffirms my position. This is a growth company. Now, moving into Outlook, they gave us Q1 guidance and full year guidance. So they expect non-GAAP subscription services and financial technology services gross profit in the range of $275 to $285 million, representing 20 to 24% growth year over year. Adjusted EBITDA in the range of $15 to $25 million. As for the full year 2024, they expect for that non-GAAP subscription services and financial technology solutions gross profit to grow between 23 and 24% year over year, and adjusted EBITDA in the range of $200 to $220 million. Now, when it comes to cost cuts becoming more profitable a bit faster, they already did major cost cuts before, back in 2020, and now they continue. On February 13, 2024, TOST Board of Directors approved a restructuring plan designed, they call it the plan, El Plan, designed to promote overall operating expense efficiency, including a reduction in force that is expected to impact approximately 550 employees, as well as certain other actions to reorganize the company's facilities and operations. As part of this plan, the company expects to incur restructuring and restructuring-related charges of approximately $45 to $55 million. But they did say during the earnings call that in the long term, they expect cost savings to reach around $100 million thanks to all the restructuring, aka cost cuts, layoffs. They then also announced a share buyback program of up to $250 million of its Class A common stock. When will they buy their shares? They'll decide the best time to do so. Now, one important thing here, or maybe two important things here. Despite it being a growth company, we have to look at how it manages to grow that fast. And so I always like to look at the increase in total revenue, which we've seen before, 34% year over year. Then you look at the cost of revenue. How much is it costing them to increase that revenue by that amount? And as you can see, total cost of revenue increased also 30% year over year. So you're saying that for them to be able to grow at 34% year over year, the cost to grow is also increasing 30% year over year. So what happens when they spend a bit less? Is growth going to disappear suddenly? or not? That's the question. It is true that if we look at operating expenses, total operating expenses, that did not grow that fast at all. But still, cost of revenue increased 30% year over year, while total revenue increased 34% year over year. Something to keep an eye on. Not a red flag, but definitely something to keep an eye on. Now, in short, what does TOST offer? So this is the TOST platform powering restaurants. Point of sales and restaurants operations, financial technology solutions, marketing, digital storefront, team management, supply chain, and accounting. This is what they offer. They then have platform and insights, support and services as well. If we go down a little bit, we can see that, well, they've got two, let's say, models, one recurring and one-time. The recurring model is subscription services and financial technology solutions. Then the one-time are hardware and professional services. Now, they being very, very focused on the restaurant industry, which they say here is one of the largest industry in the US and globally, with 860,000 locations in the United States, 22 million locations globally, $1 trillion annually US sales, which is around 4% of GDP, and over 12 million employees in the United States. You can basically say that, yes, there is still a very, very long way to go. If you look at the total addressable market here, they say global TAM $110 billion plus US TAM $55 billion. And when you look at their own ARR, it's just $1.2 billion. So yes, the opportunity here is extremely big. But with that, I want to switch back to my comparison between TOST and Square, or Block, should I say, but it's Square that deals with restaurants. So first of all, TOST right now has a market cap of $12 billion, forward PE 74.3 times. As you can see, Square right now, Block, has a forward PE of 23.3 times, EV to EBITDA 18.3 times compared to TOST 54.8 times. Price to sales, Block just 1.7 times compared to 2.5 times TOST. Then with regards to price to free cash flow, 51.2 times for Block and 112.1 times for TOST. This is in the last 12 months. So again, I'm asking myself, and not myself because I own Block, but I'm asking people that are investors in TOST, why would you rather pick TOST than Block? Because like I said, Square, Block is also playing in that huge total addressable market with regards to restaurants. And they have a much larger ecosystem, in my opinion. Afterpay, Cash App, Square ecosystem, the whole shebang. Now, with regards to Block, has a market cap of $40 billion. And if you look at their growth expectations, I mean, you can classify this as well as a growth company. Yes, it's true that sales are not going to grow over 20% like we've seen before. But if you look at EPS, they are becoming or expect to become more and more profitable over the coming fiscal years. I mean, paying 23.3 times forward PE for a company that is expected to grow EPS by another 30% in the next fiscal years, not too bad. While it is true that the market, and myself included, are still waiting to see the effects or the promises of making Block a more linear, a faster growing company in a more profitable way, I would still bet on them other than TOST, which eventually will maybe look like an acquisition target. Remains to be seen. Right now, they're still doing great. There's no denying that. But from an investment standpoint, I rather own a company that plays in different segments, huge industries, rather than a company that focuses just on one. We've talked about this in other videos as well. You rather own an infrastructure or a company that can have plenty of features rather than focus on a company that just is a feature. So there you have it. Of course, I can be completely wrong. Do share your opinion down in the comments below. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.